Welcome to Benchmark's third quarter market outlook. I'm John Swift, the Chief Investment Officer for the Benchmark Companies. Today, the Federal Reserve has become the focal point for the market as inflation, Fed asset purchases, and the timing of future interest rate increases dominate the current narrative. I'm going to be talking about three major points today. The Fed finally began to talk about its tapering of its $120 billion monthly asset purchases of Treasury bonds and mortgage-backed securities, since the economy and inflation are stronger than initially projected. Two, the Fed will not take any actions that put at risk the current economic expansion, but tapering its mortgage-backed securities makes sense, since the housing market has been robust and does not need the help of the Fed at this point. And finally, I'm going to talk about the Fed actions actually will extend this current economic expansion according to our research. At the last meeting of the Federal Reserve's Federal Open Market Committee meeting, they made a most significant hawkish shift yet, accelerating its timeline for hiking the federal funds rate into 2023 from 2024, and setting the table to end asset repurchases as soon as this year. The central bank left little doubt that the government's monetary and fiscal stimulus has reinvigorated economic activity. The federal bankers believe that the gross domestic product, or GDP, will grow at 7% this year, up from its 6.5% forecast in March, resulting in core inflation up 3% this year from its original outlook of 2.2%. Now, historically, the Federal Reserve has a reputation for underestimating inflationary pressure, forcing it to act more quickly and aggressively than it originally planned. But you may remember that the Fed announced at its Jackson Hole meeting last summer that it was willing to see inflation above their 2% target for a considerable period before acting to reverse its course. The reasoning for this position is that due to the extended period of years where we experienced inflation well below the Fed's 2% target, we need a period of higher inflation to recalibrate market expectations for future growth and price levels. Whether this means the Fed is behind the inflationary curve now is anyone's guess. But if it is, then we may see an even more hawkish tone over the coming year. The Fed has a dual mandate for full employment and keeping prices contained, but the Fed's stated intentions today are to see continued progress in returning to full employment, and reaching that objective will be the primary determinant of the timing of interest rate hikes by their reckoning. Of course, it is easy to commit to tolerating higher inflation when it does not exist. Last summer, you may remember, when they made this initial proclamation at their Jackson Hole summit, CPI was only running at 1.2%. Still, it is something else to ask these Fed governors who are steeped in a tradition of fighting inflation to stand by idly when prices are rising at their fastest pace since the 1970s. Already, there seems to be some nervousness amongst a few Fed governors about sticking to their higher for longer pledge on inflation. For now, the Federal Reserve stance has sparked a tug-of-war between those arguing rate hikes are too far off in the future to worry of a slowdown, and those believing the Fed's timeline is still too optimistic. We've got some confusing signals from the bond market. With CPI forecast to hit close to 4% later this year, that does not sit well with the bond market trading at 1.5% yields on the 10-year Treasury. Even if inflation moderates, as the Fed and the market predict, the market is still expected to average almost 2.5% for the next 5 years. Bond investors will not stand idly by and continue to accept a negative real yield of close to 1%, which is 2.5% inflation minus the 1.5% Treasury yield. We believe that the 10-year Treasury is heading towards 2% in the coming months, which will cause some anxious moments for the stock market, just like the rise in Treasury rates during the first quarter of this year that really hit the market hard. And here's just a small list of factors that should be causing higher yields on Treasury bonds. 1, the massive fiscal and monetary stimulus. 2, the double-digit economic growth. 3, widespread wage increases. 4, the prospect of massive infrastructure spending due to the $1.2 trillion infrastructure bill that's being discussed. And finally, number 5, future reopening gains as vaccinations continue to spread worldwide. That's not an exhaustive list, but just a couple. At some point, the bond investors will not be satisfied investing in a bond with a negative real yield. Rates must rise to make this a more economical investment. Another point of view on rates is that bond investors are forecasting a significant slowdown in economic expansion later this year due to high inflation, geopolitical tensions, and COVID variants ramping quickly, which could cause inflation to drop along with valuations in the equity markets. Additionally, bond investors may believe that we are experiencing a high watermark for GDP growth, corporate earnings, and an accommodative monetary and fiscal policy. They figure the receding waters in the quarters to come will be swift and turbulent. We do not share this view, but it is a narrative discussed to justify today's low interest rates. Now, concerning future earnings growth, new auto and home sales did stagnate last month, but that has more to do with supply chain issues in the automotive business and affordability. In the housing market, an uptick in mortgage rates, as well as affordability issues again, are taking hold there. The former in the automotive industry will return to sales growth as supply chains issues abate, and the latter in the housing market is, I think, a necessary respite for a housing industry that was quickly heading towards a pricing bubble. Finally, we are less worried about CPI getting out of control, as we believe an increase in productivity caused in part by higher capital expenditures by corporations and the $1.2 trillion spending in infrastructure by the government will offset most of the wage gains, which is, after all, 2/3 of CPI. Additionally, the inflationary pressures from the U.S. conflict with more deflationary impacts globally. There is still a lot of slack in the land outside of our borders, which acts to keep a cap on price increases generally. We'll turn to our investment outlook. The economy is strengthening and inflation is accelerating due to supply shortages as production is not caught up with final demand. Over half of that increase is transitory, but it may take a year for these problems to abate. As a result, inflation will be persistent into 2022, but the rate will fall as we progress further into that year. The Fed does not want to do anything that will slow this economy, and getting unemployment back to its pre-pandemic lows remains the primary objective of the Federal Reserve and Congress. We remain confident in investing in economically sensitive areas such as the consumer discretionary sector as well as technology sectors, where we expect companies to report surprisingly strong earnings, profit margins, cash flows, dividends, buybacks, and return on invested capital. Additionally, the prospect of higher mid to long-term interest rates with short rates anchored to the seafloor by Fed policy bodes well for the banks who borrow short and lend long. Additionally, with all 23 systematically important financial institutions, which is government speak for big banks, passing the Federal Reserve stress tests suggests that hefty dividend hikes and stock buybacks lie ahead. Both of these were excluded during the pandemic as the Federal Reserve was mandating that big banks reserve and marshal in their capital. Finally, with inflation running high and economic growth peaking in the next quarter, investors need to look deeper into company businesses to find out which firms can succeed in a more challenging economic environment. We focus on profit margins and economic profitability to identify firms with pricing power. These types of companies can raise prices as their costs increase to limit the damage wrought by inflationary forces. We look forward to catching up with each of you, and we will be reaching out to schedule a time to meet in person or by Zoom or MS Teams video. If you would like to get something on the calendar in the interim, please send me a note with some times and dates. I look forward to seeing you, and have a wonderful summer.